Hey everyone, today we'll be talking about tax groups as per the UAE consultation documents for corporate taxation. In the UAE, there are many companies that operate as a group of companies, and for them to operate as a tax group will help reduce a lot of the compliance and admin costs as well as reduce the tax effective rate. Before we move ahead, please click on the subscribe button and the bell icon to stay updated on our future weekly business and finance related content, which is incredibly useful for business owners, CEOs, CFOs, entrepreneurs, and those who aspire to be one. Now let's get back to the video. Before we get into the details of corporate taxation for a group of companies, we need to understand that the consultation document talks of two types of groups of companies. The first case is a tax group where you have one registration and you have to file a single return as a group. For this case, 95% of the group of companies must be commonly owned, which is essentially wholly owned. And the second case is just group, where you can take benefits of transfers of losses between these group companies. However, in this case, each entity may need to have a separate registration and file returns accordingly. For this case, 75% of the group of companies must be commonly owned. So let's discuss a little bit more detail on who is allowed to form a tax group. As per the consultation document, to form a tax group, the following conditions have to be met. Firstly, like we discussed earlier, parent company must hold 95% shares and voting rights of the members. Number 2, all group members must have the same financial year end. Number 3, the parent company and the member companies of the group should not be exempt for corporate tax. Number 4, the parent company or the member companies in the group should not be a free zone company that is taxed at 0%. And finally, the parent company and member companies of the group must sign a notice and submit to the FTA. Branches and subsidiaries are also allowed to be part of the same tax group. So what does it mean for the member companies and the parent company to be a part of a tax group? The parent company is responsible for all the administration and the payment of tax. The parent company must also consolidate the financials of the group. Intercompany transactions must be eliminated. And finally, the members of the tax group will be jointly and severally liable for the corporate tax payable, which is including the parent company as well. This joint and several liability can be limited to one or more named members of the tax group with the approval from the FTA. What are the conditions for group companies to transfer losses amongst themselves? Firstly, 75% of the company must be commonly owned. So we can note here we are not talking about tax groups. Secondly, the company is not exempt from corporate tax. Number 3, the company is not a free zone company with 0% corporate tax benefit. And finally, the total loss that is offset will not be more than 75% of the taxable income of the company that is receiving the transfer. We can see that from these conditions that it is not as strict as the tax group conditions. Now let's get into the next point, that is it important to record gain or loss for transfer of assets or liabilities between group companies? As we discussed in the case of loss transfers, assets or liabilities can be transferred at net book value and no gain or loss need to be recorded for the same. However, if the 75% condition is ceased to be met, the period in which this happens, the gain or loss needs to be recorded. What are some of the corporate tax impacts in the case of a merger, acquisition, or restructuring? Firstly, a restructuring relief will exist, where there would be an option to defer the corporate tax payment. Secondly, in the case of acquisition, the acquiring company will continue to use the transferring company's existing tax basis for all the transferred assets and liabilities. What this means is that no gain or loss need to be accounted for the same. The current net book value of the tax basis is what's going to be accounted for. Any of these reliefs that we have discussed will be clawed back if there is a subsequent restructuring again within the next 3 years. So it's important that the acquiring company holds on to the new companies for at least 3 years to make sure that they are taking advantage of this relief. Hope this video gave you a better idea of how groups of companies will be treated in the corporate tax regime as discussed in the consultation document in the UAE. We've now reached the end of our discussion. If you like the video, hit the like button and subscribe to our channel. If you want us to talk about any specific topics, please do let us know in the comment section below. See you in the next one.